Now we have 9 people in attendance, so let's start. So technical analysis. So I spoke of fundamental analysis the other day. That was on Monday. And I explained to you how these fundamental events can affect the market. And I gave you a number of examples. We spoke of economic factors. We spoke of political factors, weather-related factors. And I also mentioned some before people who are very important as far as this market is concerned. And so whenever you listen, whatever they see can make the market extremely volatile. It can either decrease or increase the value of the currency temporarily. Sometimes the effect will last a little longer. And today we are coming to look at technical analysis. So when we say technical analysis, what exactly are we referring to? This is a form of forex analysis where the attention is more on the charts than the news. The attention is more on the charts than the news. So what's a chart? What you are looking at is a chart for the dollar index. Okay. So what you are currently looking at is a chart for gold. All right, so let's use this. So what you're currently looking at is a chart for euro USD. That's the euro against the dollar. And as a matter of fact, this is the most traded instrument in the whole world. Not just the most traded currency, but the most traded financial instrument. Because the dollar is the most traded currency in the world, and the euro is the second most traded currency in the world. You have the most traded currency in the world quoted against the second most traded currency in the world. That cannot make it the most traded currency. So euro USD has a lot of liquidity. The market will say is that it means there are a lot of market participants as far as that particular asset is concerned. So it's easily tradable. Let's put it down. It's easily accessible because of the market participants that it has. So if you take a currency pair like the dollar Ghana cedis, you can't be trade because it doesn't have any liquidity. That's because it doesn't have market participants. You understand? So this is a chart for you. And what is a chart? The forex chart, some people call it graph. Lay people call it graph when they see it. So it's a chart, and the chart is nothing but a graphical representation of price and time. Time on the horizontal axis, price on the vertical axis. Let me take that again. I said the graph is nothing but a graphical representation. The chart is nothing but a graphical representation of price, of time and price. Time on the horizontal axis, price on the vertical axis. And these two axes are extremely important for your analysis. So we have so many types of charts. These are all types of charts. But the commonest ones are the line charts. That looks like this, where price is represented by a line. Bar chart, that looks like this. So these are bar charts look like. This is hard for me to interpret, but there are people who interpret this trading. Yeah. In my trading career, I've met only one guy who uses bar charts. One trader uses bar charts for his analysis. So this is a bar chart. Then we have candlestick charts like this. So why do we call these candlestick charts? Very, very simple. Because they look like candlesticks. Let me zoom so you can look at them closely. And realize that they look like the very candlestick. You know, see, this looks like a candlestick. This is all of them. That's what we call them candlesticks, specifically Japanese candlestick, because they were invented by a Japanese man. I think 17th century. His name was Munahisa Homa. You can read about it. It's based on his teachings that they created the book Forex Candlestick Bible. There's a book like that called Candlestick Bible. And that I used to touch on some of the but I no longer because I don't teach candlestick patterns anymore. So I don't talk too much about it. But it's a very good thing for to understand candlestick patterns. Yeah. So I noticed that what I teach, you don't need candlestick patterns. That's why I stopped teaching them. So this is a chart, the forex candlestick chart. So now to get to a level where you can easily interpret these charts and then uh, look for opportunities to trade. You must first of all learn how the candlesticks are formed. When you look at them, you realize that they have different colors. Some of them are green and some of them are black. Why is that? We're coming to look at that. So we're coming to look at how the green candlesticks form and how the black candlesticks form. I will do one today, then the next lesson we'll do another one. So, but before we look at that, let's look at something that I will in order to explain these candlesticks. So, I'm going to talk of how the market generally moves. Okay, the market moves in three directions. The market moves in three directions: sideways, and when it is moving sideways, we say that it's a consolidating market. That's consolidating, it's choppy. Or when the market is moving sideways, this is what it looks like. What do I mean by moving sideways? It means there is not going in any clear direction. It's just trading between two short ranges. So this is a choppy, the consolidating choppy already market. So that's one direction. The second direction is like this. This is an upward. Random markets. Also have this downward random markets. These are the directions I'm talking about. Upward trending market. Of course, as you can see, the arrow is pointing upwards. Downward trending market. As you can see, the arrow is pointing downwards. Then consolidating or choppy origin market. And we do not trade when the market is consolidating origin. And I'll explain that very soon. We only trade upward trending markets and downward trending markets. So I need to know that there is something called consolidates market because the market consolidates every now and then. It's quite common for you to see the market consolidating. Now there are words to describe upward trending markets and downward trending markets. You should know those words as trader. There are also words we use to describe that word. So let's look at this word secondly. So we start from that point at the market. Now, the first word is the word bullish. So when the market is going up, that's when it's an upward trending market. We say it's a bullish market. Why do we say it's a bullish market? It's because it is behaving like a bull. You see how bulls attack their victims? I use the word victim because bulls are herbivores. They do not eat. So when they attack you, it's not because they want to eat you, it's just because they don't like you. Or maybe they don't like the color of the shirt you're wearing. So how do they attack? They have very powerful hooks that they are able to use to hit their victim. So they hit you with the horns and then fly up. Like move up before you come down to them. So they compare another poor trading market to the attack move of the bull. That's why they refer to it as a bullish market. So if you hear me say that the dollar is bullish, it means that it is going up. It's moving in an upward direction. That's what I'm saying. It is bullish. So you must understand this thing. And the second term we look at is long. Now, when we say a market is long, it means that it's going in an upward direction. But why do we use the word long? Now, some of these things I will explain using analogies that make sense to you, that I know make sense to you, but they are not necessarily the industry standard. I just thought of them, they made sense to me. They made sense to me as far as related to them to understand what this thing is all about is concerned. So the long, let me give you an analogy. Say there's a mountain, you have two people. One is going up the mountain, the other is coming. Let's say a hill. What is really a mountain? A hill, a very steep hill. One is going up the hill and another person is coming down. Which of the two individuals will take longer? Is it the one going up or the one coming down? The answer is obvious. To take the person who's going up and a longer time to get to wherever he wants to get to, that it will take the person who's going up because it's going up against gravity. And then that can contribute to making the person take longer to get to the top. You understand? So when the market is going up, we assume that it is going up a hill or going up the mountain. That's why we say it's a long market. But there's a school of thought that believes that, technically speaking, it takes the market a longer time to go up than it takes it to come down. Yeah. So when you hear me say something like gold is a long market, or you ask me, we're having a conversation and I tell you I took a long position on gold. All I'm trying to tell you is that I'm not gold. You understand? So don't let these terms confuse you. They're very, very simple to understand. Then the fourth word, the third word is rally. Now I would like to use my own analogy to explain. Remember what I said, it is not necessarily industry standard. So let's say NDC or MBP is having a political rally. What is going to happen to the number of people within that jurisdiction where the rally is being held? We are going to see a rise or an increase in the number of people. Why? Because their supporters will come from all the four corners of Ghana. Some might even come out of Ghana. Some might even come from outside Ghana. Just come in. Some might even come from outside Accra. Just to come and participate or witness the rally. You understand? So we are going to have a situation where the number of people there increases. So you have a rise in the number of people. So when the market is going up, it is rising in value, it is rising in number, so to speak. That's why we see it's a rally market. This is my analogy, not necessarily industry standard, but it makes sense to me. You understand? So if it's going up, it it's appreciated, but that's why we say it's a rallying market, a rally. When you hear rally forex, we are not referring to political rally, we are referring to upward, to bullish movement, to long movement. That's how this thing works. But I hold on with the fourth word because I need to compare it to dovish from the bearish side and then explain. So let's go straight to bearish. After that, I'll differentiate between hawkish and dovish. Now, when the market is going down, we call it a bearish market. Why? Simple. We compare the action, the movement of the market to the attack move of a bear. I have never come across a bear before. I agree that I never do, because those animals are very, very dangerous animals. Extremely dangerous animals. I've watched documentaries about them on the National Geographic, and they are very, very strong. Very, very strong animals. Now, do you see how they attack their prey? I say prey because they are coming when they are attacking. They are attacking because they want to eat. They hit the prey with their palms to the ground. They have palms. That's it. What I'm trying to say is they hit the prey with their hands to the ground. And then they start to attack. They start to turn to the flesh of the prey. So their attack mode is the exact opposite of that of the bull. Once the bull is attacking by hitting to go up, this one is hitting to come down. So when the market is going down, we compare it to the attack mode of a bear, and then we say it's a bearish market. So if you ask me what do you think of the dollar, and I say the dollar is bearish, all I'm trying to tell you is that the dollar is going down. Now, those of you who have been around on this platform for a while are probably wondering why is Hunter sounding so basic? It is because there are a lot of people on the platform. Two platforms actually that has very, so I'm treating all of you as students, and I will build up upon this basic stuff all the way to the intermediate and the advanced level. So if you feel I'm sounding too basic, it is because of the presence of the community. These are great people that don't know anything about forex. They are out there, just like sometimes people usually don't know anything. Then the second word, short. Back to the hill analogy. Yeah, I said that it will take the person that is going down the hill a shorter time. So when the market is going down, we assume that it's going down the hill, so this is a short market. But then once again, there's a school of thought that believes that it takes a shorter time for the market to go down than it takes for it to go up. You understand that? Yeah, that's why we see it is a bearish, it's a short market. So if you ask me what I think of gold, and I think I'm short of gold, or I've taken a short position of gold. I'm trying to tell you that I'm selling gold. But then the next set of words, tip, plummet, tag, these are normal English words that they are thrown around. For those of you who watch football, sometimes when a player loses form, they say, oh, the player has a dipped form, or the player's form has dipped. That's because the player's performance has reduced drastically. It's a normal English word that we throw around all the time. Same thing can be said for plummet. When we say something is plummet, it's dropping really hard. The tank also is that it's dropping really hard. So dip, plummet, or tank are all words that can describe the market that is bearish. Then the fourth word out of this, dovish. So let's go back and compare it to the hawk. The hawkish. Now over here we are talking of two birds. We are comparing two birds that do not fly at the same altitudes. One flies at a higher altitude than the other. So if you take the hawk, that has very strong wings. It's one of the highest flying birds. Hawks fly really high. Doves do not fly really high because they can't. Their wings are not very strong. So they fly so low that if you are good at throwing stones, you can easily throw down enough. So when the market is going up, you assume that it's going up. It's flying high like the hawk. That's why we see it's a hawkish market. Once again, this is my analogy, not necessarily industry standard. Then when the market is going down, it's flying, it's going low like the dove does. That's why we see it's a dovish market. So you need to know these steps because once you have decided to become a trader, naturally you are going to develop interest in reading about news, like business or forex related news. And when they are describing market cycles, you see some of these steps, they change them because it will be very boring for you to read an article talking about how gold is bearish. And then you see the word bearish, 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 bearish. At some point, that will sound extremely boring. So throwing in these other words just to keep the conversation or the discussion live. So instead of repeatedly saying bearish, they might say short, say dip, say planet, say tackle, say dovish. You understand? So as a trader, you should know these steps. Knowing these steps is not automatically going to make you a profitable trader. No, but you must know them because these are terms that are exclusive to just the financial markets. You know, once you are trading forex, you are part of the financial markets, you must understand these terms. It's like being a medical doctor. It's very shameful that you call yourself a medical doctor and then you meet up with other medical doctors. Use the term non-alcoholic steatosis, which is just a big term for non-alcoholic fatty liver disease. It's one of the diseases that affect the liver, alcoholic or non-alcoholic. So you hear them say non-alcoholic steatosis, and you're like, hey, what does it mean? That would be very shameful because you're a doctor, you should know what that means. Same way, if you call yourself a trader, then you have to other traders and you say gold is a long market. It's very shameful for you to answer what has this long market. But a trader and people want long market. One of the reasons why we must understand these steps and what they're going to do. Yeah, so that's it. We have talked about all these steps, but the ones we see more commonly are bullish and bearish because these ones existed before the other ones did. So most traders use bullish and bearish instead of long, short, and all these other things. Okay, so Fred is suggesting that you guys take notes. Yeah, it's a good take notes. It helps you remember what you were taught. What else the university? That was hard. You are teaching me and I don't write something down, or I'm learning and I don't write something down. It's hard for me to remember what I write down. But as I write, it becomes self to remember. So while I'm teaching, it's good that you take notes. Then when you have access to it afterwards, as well. It's a great way of learning. So now let's get back to the main topic, candlestick anatomy. That's what I'm coming to look at. So as I said, all these terms we looked at are very important, but the ones we use more commonly are bullish and bearish. Now let's talk of candlestick anatomy. When we say anatomy, what does anatomy is parts of something? So if you hear human anatomy, we are talking of the parts of the human body. One of the things, one of the topics that you must master if you want to become like as a medical student, you must master the parts of the human body. Same way, if you want to become a trader and you're going to do candlestick charts, you must master candlesticks and what they represent. Now, I like to compare or liken the market to the body, to the human body. I think they have a lot in common. Or should I say, I think they have something in common. Okay. So we are coming to look at candlesticks. Now, if you take the human body, each and every one of you is meeting right now, they are currently 11 people here. If you add me, that's strong. So all 11 of each of you has trillions of cells that have come together to make up your body. Each and every one of us. Not billions, not billions, not hundreds. Trillions of cells have come together to form your body. You understand? So the cells come together to form tissue. Tissue come together to form Organs come together to form organ systems, and the organ systems come together to form the body. So let us take the largest organ of the human body, which is the skin. That's the largest organ. So take your skin, for instance. That skin you are looking at is made up of trillions of cells. I come from a medical background, so I know these things for real because I've seen some of these cells under the microscope. I used to work at a clinic that specializes in the treatment of skin diseases. So I used to work with people's skin a lot. Skin in every part of the body, even the private parts. People have this. Some people come there with some dusty skin disease on their private parts. You have to screen it and examine. The medical profession takes a lot of passion and patience. It's not something really like you can. Yeah. So my experience over there, let me see how the human cells look like, both the healthy ones and the diseased ones. Okay. So if you, like I was saying, let's take the skin for instance. Your skin is made up of a lot of squamous epithelial cells. Each of these cells is very important. Together, they form your skin. So if something happens to your skin and the cells are compromised, let's say you have a parasitic infection on your skin, okay, you will see it on the skin. Even though you see that part of the skin looks weird. So when it's examined under the microscope, if there's a parasite, you shall see the parasite. Now, when you compare the cells of that part of the body to, the part where the sickness is, the infection is, and you compare it to another part of the body that is normal, that doesn't have an infection, you see a difference in the anatomy of the cells. The cells, even though they are all squamous cells, look a bit different. Why? Because one is normal and the other is what? Sick because it's infected by a parasite. Why am I telling you this? I'm telling you this because it is the medical professional's job to first of all know what the normal cell looks like. So when he sees an abnormal one, he knows that now there's something wrong. But if you don't know what the normal cell looks like, and then you come across an abnormal one, you can't tell. Because you don't even know what the normal one looks like in the first place. You understand? You can't even tell what the normal one looks like in the first place. So to get to a point where you can know exactly what's happening in the body, you must first of all know how the cells are functioning. Take the liver to for instance. I have looked at liver cells under the microscope, so I know normal liver cells look very different from diseased liver cells. I remember some time back, we observed somebody had a liver disease. He had liver cirrhosis. You didn't even need to look under the microscope. As soon as you see the liver, you know that there's a problem. Because it doesn't even look normal. But if you don't know what the normal one looks like, you can't tell. You understand? That same way, if you don't know how the candlesticks form, it will be very difficult for you to be able to analyze the market as a whole. So this is USD. Let me go to the market. This is all the information we have on since we retail trade give a thing. So this dates back to 1971. This is all the information we have on this. So this is more like the body. This is a body. Okay. Now, if I zoom in, you will realize that so many candlesticks come together to form that body. So the candlesticks are acting as cells right here. Like the cells that can come together to form tissue, that come together to form organs, that come together to form organ systems before the whole body is formed. These candlesticks are acting the same. That's why I see there's some similarity between the human body and the market. So over here, the whole body is what I've shown. All the information we have on good since the inception of retail trade. The candlesticks are what? The cells. So like every good medical doctor, you must first of all understand how the cells form. If you don't understand how the liver cells form, you can't understand how the liver functions. So there's a reason why when you go to the medical school, they start you off from anatomy and physiology. Anatomy before they introduce physiology. Because anatomy is going to teach you the body parts, how they are made, the cells that make them. The physiology will teach you the function of the cells and the function of that body part in general. Before they now introduce you to pathophysiology. So you have the body and it functions properly. But what happens when the body is not functioning properly? There's an ailment. That's where pathophysiology comes in. You understand? So if there's an infection in the part of the body, if you first of all you understand how the cells over there are like and how they function, when there's an ailment, you will know. That same way, if you don't know how these candlesticks form, you can't even tell if the market is bullish or bearish. So it all begins with understanding the formation of the candlestick. That's what we're going to start from. So now we are in medical school. We are coming to look at the candlesticks. Remember, the candlesticks are our cells. So let's first of all look at how they form. Now you realize that there are two different types over here. You see some are black and some are green. Why is that? There's a reason. All of this is symbolic. So let's explain. That is because one of them is bullish and the other is bearish. We just spoke of bullish and bearish markets. So you should know what bullish means and what bearish means. One of them is bullish and the other is bearish. So I come to start by looking at how bullish candlesticks form. And I'll show you how that it's a very important foundation to understand the formation of bullish markets. So let's see how bullish candlesticks form. Now, there are different colors used to represent these candlesticks. So the industry standard, or the default colors, what does it default and industry standard? The industry has got a standard. So the industry standard colors for a bullish candlestick are white or green. White or green. And the industry standard colors for a bearish candlestick are black or red. Black or red. But we are going to stick to green for the bullish candlestick and red for the bearish candlestick. You can customize your charts to look any way. Like if you like, you can make your candlesticks into and purple. Whatever color you like, you can do that way. But I'm going by the industry standard. So later, if you want, you can customize the chart to whichever way you want. So let us talk about bullish candlesticks and how they form. So, like I said, we're going to use a color green for our bullish candlesticks and a color red for our bearish candlesticks. Now, for those of you who are participating by practical class for the first time, this is my style. I like to use illustrations a lot because I think it helps a lot of people understand what I'm talking about. So I am currently trying to sketch or draw a bullish candlestick. This looks like some form of manual trick. So this is the bullish candlestick. Now this green surface area, the entirety of this green surface area is the body. Like the way you have body, the candlesticks also have body. So this is the body of the candlestick. This green surface, the entirety of this green surface, from the top to the bottom, from right, from left to right. All the, like the whole green surface here is the body of the candlestick. You can also see that we have some projections at the top and at the bottom. They are called projections, these black projections at the top and at the bottom. You can call them wicks. You can also call them shadow. So the older traders call it shadow. With the Gen Z people call it wick. So you can refer to these things as wick or shadow. They are called shadow because the body first went there and couldn't close over there and left the wick. So the wick is acting like a shadow. It's like Wherever your body is, your shadow is there. So you cannot be sitting in your office and your shadow is in the house. If that happens, it means that you are a wizard or a witch. A normal human being, there's no way you can be sitting at your office and your shadow will be at your body. Your shadow must be where your body is. You understand? This is what some people do on my page that I don't like. They will not show you prior analysis. Then when the trade goes in their favor, they come and post in their results. But when it goes against them, they never post it. All of that does not help because it makes people, naive people, think that it's only win. But these guys don't win every trade. I believe they lose more than they win. But they'll never post their win, their losing trades. Only their win. So this guy does lose, but that is not the case. I might end up telling, I don't know if there's a way you can turn a discussion to the channel. I might tell them because the people there, most of them let's continue what we see. So now I come to look at how the bullish candlestick forms. Now I said when we say bullish, we are referring to what? So how does a bullish candlestick form? Bullish candlestick is that it closes at the so some people instead of saying bullish candlestick, they say up close candle. It's the same thing. I heard that. Fred, you mean you know how a channel can a group can be converted to a channel? Is that what you're saying? Then after the lesson, because I want to turn that group to a channel. I don't see what the people take their purpose. They rather come there to advertise themselves. So people chat them backstage and they take money from them to teach them how to do it. You come and use our platform to advertise yourself. So it opens. Now, one thing I forgot to mention was that every candlestick you see, regardless of its size, that's whether it is big or small, is giving you 4 pieces of information. Now, one thing you must understand is that these candlesticks are nothing but price representations. They are only telling you where price has been and where price is at. And if you know how to interpret it, they can tell you where price is likely to go. That's what analysis is all about. So the candlesticks are all telling you very important information. Like I just said, showing you where price has been, where price is currently at. And if you know how to interpret the market, it's like it can tell you where price is likely to go next. That's what it is about. So each and every candlestick, regardless of the size, is giving you 4 pieces of information. It's telling you the price at which the candlestick opened, the highest level it went, and the lowest level it went, and the price at which it closed. That is basically what it is telling you. You understand? That is basically what it is telling you. And how long the candlestick takes to form depends on what time frame you're looking at. Now, the industry standard time frames, is that the right thing to see? But the MT4 and MT5 standard time frames are monthly time frame, weekly time frame, daily time frame, 4-hour time frame, 1-hour time frame, 30-minute time frame, 15-minute time frame, 5-minute time frame, and then 1-minute time frame. So an MT4 and MT5, these are the main time frames. But on a platform like TradingView, you can have access to other time frames, even 1 second time frame, 12-month time frame, 6-month range. You understand? But the dimensions are the ones available for so how long a candlestick takes from depends on what time frame you are looking at. So if you are looking at a monthly time frame, is that each candlestick you see over there is going to take 1 month to form. Each candlestick is taking 1 month to form. If it's on 4-hour, each candlestick is taking 4. So this is the monthly time frame. Okay. This is the month of July. It's now 4. What's today? Today is 12. And we've had 1 weekend so far. That means that we have seen about 10 trading days so far. Am I right? Where was first July? Now I have to go to the daily to see this. Forget that. What I'm trying to tell you is that each candlestick on the monthly time frame is taking 1 month to form. So this is this month's candlestick. By the time this month ends, this candlestick will close. Then a new candlestick when August starts. This was last month, June. As soon as June ended and July started, this candlestick was. Okay. This was May. This was April. This was March. So every month, one candlestick forms on the monthly time frame. If you are looking at 4 hours, every 4 hours, one candlestick closes, and as soon as it closes, the new one opens. Every hour, if you're on the 1 hour time, every hour one candlestick closes, and as soon as it closes, another one opens. That's how the whole thing works. So let's get back to what we're saying. So it opens here, and I told you the open is showing as the opening price. So you can say opening price, or let's just say open. Let's save some time so I don't have to type too much. But remember, the open is actually the opening price. That's the price at which this candlestick opened when it started forming. Now, for most of the time, when the bullish candlestick opens, it doesn't just go up. There are times when it goes up, but there are also a lot of times when it doesn't go up, but comes down to, first of all, from the low. The low is the lowest price the candlestick went within the time that the candlestick was formed. The time frame that the candlestick was formed. So if there's a 1 hour chart, is that at the beginning of that 1 hour, the candlestick opened at this price. Within that 1 hour, it went this way. Okay. Now it shoots up. From the high or the highest price. High or highest price. And then eventually comes down with what? A close. Close is what? Closing price. So 4 prices. The opening price, which over here I'm referring to as open. The lowest price, which is the low. The highest price, which is the high. And the close, which is the closer price. So every candlestick that opens must eventually close. As soon as it closes, a new one will open. So bullish candlesticks have this structure. They open, they come down to form below, they go all the way up to form a high, and they put one for the close. So they have this structure. This is what we refer to as what? Open, low, high, close. Open, low, high, close. And this is what we refer to as what? OLHC. This is how a bullish candlestick forms. But this is how bullish markets generally form. This is not always the case because you have instances where the market opens, doesn't come down to form this low, it just starts going up. But most of the time, it forms like this. So it opens, comes down to form a low, goes all the way up to form a high, and comes back. So let's say the month is bullish. Okay? That means that on the monthly time frame, you are going to see the formation of one bullish candlestick. Now, you can look at the market cycles. You can look at the yearly cycle. You can look at the quarterly cycle, but I don't look at that too much. You can look at the monthly cycle. You can look at the weekly cycle. And you can also look at the daily cycle. So if within the whole month, one bullish candlestick is formed, means that month, for that particular month, the particular asset you are looking at was bullish. So if I go to the monthly time, I should see the formation of one bullish candlestick. Now, I can go into that monthly time to see what happened. That's intramonthly. That is me going inside the month to see how the market played out in that month. That is intramonthly analysis. You understand? It's like doing certain cuts, open the bubble to something. So we are cutting the candlestick to see what happened in that candlestick. So I can look at it intramonthly. Now, when I go intramonthly, I should see the structure form. Now, there's a very simple way of doing that on trading view. If I want to go intramonthly, what I have to do is place vertical lines on. I must first of all come to the monthly time frame, and then I place vertical lines on the candlesticks. The purpose of doing that is to demarcate so I can go intramonthly. Now, once I finish placing the vertical lines on these candlesticks, I quickly switch to the time frame. So I come to look at what happened last month. Now, once I switch to the time frame, this was last month. From this vertical line to this vertical line. Okay. So it ended here. The period always begins on the candlestick. So this month will be over 10th July. It was on the month. That was the last week, was 10th July here. You understand? So this month, this month has come down to form. And it is going. It's a bullish month. Look at what happened last month. The month will be here on this bullish candlestick. Look very closely. Month will be here on this bullish candlestick. And it came down here to form a low. Went up here to form a high. And why did it close? It came all the way down here for the close. You see, this is not the structure I will show you when we're looking at it. When I'll show you the candlestick anatomy. You see, open, low, high, close. If you go back to the monthly time frame, you'll see that one bullish candlestick from last month. So let's go back and look for last month. This was last month. This is this month. This was last month, June. So June, one big bullish candlestick. Intramonthly, we are going inside the month to see what happened. And how do you do that? Once on the monthly time, just place vertical lines on the candlesticks. You can go as far back as you want. So if you want to go further backwards, you just have to place more lines. I don't want to go that far back. I just wanted to show you something. So we are looking at what happened last month. Intramonthly, so I place the lines and I switch to the daily time frame. I should see that open high low close structure. And this is it right. So if you understand these things, now you've done your analysis and you know that June is going to be bullish. All you need to do is look for support levels that support or that are in line, or should I say that align with this structure. That's what we do at the intermediate level. So I just wait for the low of the month to fall. Then I get, if you're a swing trader, you can ride it all the way to the top. So typically, if this is going to happen at the beginning of that period, which in this example is a month, the first few days of the month, you see that the market is going down. Why? It is coming down to form a peak formation low, which is the lowest level the market will go in that period. Once that low is established, then it starts going down. So right from the, say, second week to the third week of the month, you are likely to see strong bullishness. Then towards the end of the month, remember the month is ending. And so on the monthly time frame, the bullish candlestick is closing. So like I showed you over here, as the bullish candlestick is closing, on the bullish candlestick, you see that it will start to form a wick. As it's forming a wick, what it means is that the market is coming down for a close for that month. But when you go intramonthly, that can serve as a very nice opportunity for you to catch some sales on the initial buys. And these are advanced things that we'll look at in more detail. So as you can see from this illustration over here, on the 23rd of June, the market started coming back down. So that was towards the last week of the month. Now look at this month, which is also obviously very bullish. Where did it go? came down to 4. What's today's date? Today's 12. So we're almost in mid-month. We're almost in mid-month. So that means it is probably a bad idea to be looking for sales for US long term at this moment because we are still in mid-month. That means that what we are seeing right now, US is likely to go up further. If anything, it might just go back for more money. Then towards the end of the month, we are likely to see sales on USD. You understand? By then, it would have traded into a good resistance level. That will cause it to come down for that push. That's how this thing generally works. But bear in mind, this structure does not always fall. There are times it doesn't fall because sometimes, like I said, the market just moves and it starts going down or coming down. But this is likely to happen 6 to 7 out of 10 times. And those are very good numbers. So the bullish candlestick that is forming on the monthly time frame is a representation of what's happening over here. So that bullish candlestick is the body. Go in, that's a cell. Go in and look into the cell to see what's in the cell. So if you take the human body, the cells, when you go into the cell, you see cytoplasm. Where the cytoplasm is like it's like a suspension where you find a lot of other, how do they call it? I'm forgetting my medicine. We have a term for this. I forget these medical terms. Inside the cytoplasm, they call them, they have a term for those things. You see mitochondria, Golgi bodies, and some other stuff. I forgot their names. Organelles, yes. We are a shark. That guy is a shark. They are called organelles. You see mitochondria, you see all those things. Then you also see nucleus. But the nucleus is not in the cytoplasm. That one is the nucleus is like the heart of the cell. You understand? So when we identify the cell on the monthly time frame, which is the monthly candlestick, and we are doing intraday, means that we are going inside the candlestick to see what is in it. That's why we are looking for the organelles inside the cytoplasm. We are looking for them. So the forex market is just like the human body. I see a lot of similarity. So that is what we are doing. So this is how bullish candlesticks form. Now next lesson, I wanted to Friday, but I'm not too sure because Friday I'll not be available. Let's see. If we can't have it on Friday, perhaps tomorrow. I'll confirm tomorrow morning or afternoon if we have the webinar. Because I want the webinar to try to show me a bit faster. So because the last one I organized, I didn't complete the market structures. So that's why I'm doing. So I have to complete everything. The man has to finish before it starts. Yeah, so this is where I'm also. Take your questions. If you have any questions, this is more the best time to ask. I'll give you guys 2 minutes to ask your questions, and I'll answer it on quality. So what are your questions? Ask me.